All right, good evening, everybody. Thank you for joining us both via Zoom and in person. And so my name is Robert Cruz. I'm one of the partners here at the Lutz and Cruz Group, Powered by Place at Keller Williams. And so what we like to do for the next 30, 40 minutes or so is kind of talk about what's going on in our market, our real estate markets here in Silicon Valley. It's not focused specifically for a buyer or seller perspective, more the total view of what's happening. And we'd love to give you some insights, not only to what's happening as we describe it, but how we get to and do the analysis to give guidance on what's going on with our markets, what's going on with prices, what's going on with interest rates, affordability, and things like that. Things that are very, very heavily in the news right now. We'll try to teach you or show you how we take and receive that information and distill it down to what's really going on in our local markets. And then more importantly, for individual buyers and sellers, what's going on based on their conditions, their concerns, their opportunities, their timelines. I think I'll show you, hopefully, that it's not that the news we receive on a national, regional level is wrong. It is actually quite accurate, in my opinion, but it's not designed to advise or guide the individual buyer or seller. Certainly not designed to incorporate what's going on in any particular specific market. And that's especially important in our Silicon Valley market. I'm biased. I've been working real estate here for 20 plus years. So I enjoy it. I study it every single day. It kind of defines what I do almost every single week and month. But that's also brought me a pretty unique perspective on how to understand it, how to explain it, and how to help people make really important decisions around their real estate needs. So if you're in the audience, you have a question or clarification, raise your hand. I'll call on you if you are on Zoom. Carol is watching. If you have a question, you can raise your virtual hand or type in a question and she'll relay it to me. So I do move a little bit fast. That is by design. This is not designed to be an answer all your problems and issues and questions around real estate. Quite honestly, it's designed to show you how we engage with data, how we engage with information in our local markets, how we interpret the national, regional news that we get. Once again, to sit with you, identify what are your questions, what are your concerns, how can you as a consumer take all of that information and distill it down to what you need to know to make really important decisions. So with that, we'll jump right in, make sure my pointer and my clicker are working. And let's start where I always really like to start, and that is with a clicker that actually works. Give me one moment. I'll have to go. All right. So I found this article. I have so many sources of real estate news, and I saw this one recently. I really liked it. When you read the title, you're thinking, why would you like that? It says, we're in the second biggest, oh, it's covered up. We're in the second biggest price correction of the post-World War II era. Here's the latest data. Fortune magazine, Lance Lambert, written December 28th, right? And if you've been following real estate at all, you know the biggest price correction he's referring to is that 08-09 crash, not only here locally, but nationwide and really worldwide. At that time in Silicon Valley, for example, kind of trending from West Valley to East, we lost anywhere from 25 to 40% of local values in real estate, right? So I was working in this market at that time. I can viscerally feel how I felt then, even thinking about those kind of price declines, working with buyers and sellers at that time, especially sellers who saw so much of their hard-earned equity literally fly out the window overnight. That's still imprinted in my brain. I still remember those conversations. So I don't take headlines like this lightly, but it is very informative, right? So it's positive. We're in the second largest price decline since that time. As I just said, those were 25 to 45% declines. It's not a headline to take lightly. And you might be thinking, wow, what a way to start a real estate seminar, right? But there's a point to this, and I'll get to it, right? He starts by saying, speaking to reporters in September, so this was 4 months ago, almost going on to 5 months ago, the Fed Chair Jerome Powell made it clear that going forward, the U.S. housing market would get reset by a difficult correction, right? The important thing here is what we're seeing in our markets, the confusion, the ideas of are we rising, are we falling, if we're falling, how much, when, where. It was all predicated on decisions made by people. It was not a natural event. It wasn't a sudden decline in credit worthiness or availability of credit or anything inherently to do with our properties, right? And so what was that human action? It was this idea that the price appreciation that we were experiencing nationwide and included here in Silicon Valley was unsustainable. In 2021, 2022, we were seeing 15, 18% year-over-year growth in the values of our home. Now, if you held that real estate, you were very happy with that. You saw the valuations of your properties grow and grow like it never had before in a given year or any 2-year period. We saw 35, 40% gains in those 2 years nationwide and here. When you're talking about an asset with median prices around 1.2, 1.3, when we started that climb, you ended up with that asset with median valuations of $1.8 million, $200,000, $300,000, $400,000 gains in a 24-month period. Again, if you owned that real estate, you weren't complaining. You were very, very happy. If you were trying to buy real estate, it's a completely different story. Not only was the value going up really, really fast, the competition to attain those real estate assets was so heated, you had to go in fast.
ఈ మండే వస్తాను ఇంకా వచ్చే వీక్ వస్తాడేమో అందుకని
searches and your offers, and that again fed into this rapid acceleration in values. The Fed stepped in, looked at housing as such an important part of the economy and looking at the problem that inflation was causing system-wide, and they very specifically said, we're going to slow this pace down. How do you do that? In the article, it further reads, houses were going up at an unsustainably fast level. So the deceleration in housing prices that we're seeing should help to bring prices more closely in line with the rents and other housing market fundamentals. That is a good thing. For the longer term, what we need is supply and demand to get better aligned so that housing prices go up at a reasonable level and at a reasonable pace that people can afford houses again. Now, a couple of really important points. When the Fed chair is talking about reasonable appreciation, there's a number associated with that. It's in the 2 to 4% range. Commonly, we expect that if house prices increase in that 2 to 4% range, that is sustainable in that we can continue to find more buyers to buy those houses at those growing prices. And they can afford it. They can sustain it. And of course, that does help the current homeowners. The value of their properties are rising. It helps future homeowners. Once they get in, their values continue to rise, right? So that idea of like, if you already have it and it's going up 15, 18%, that's awesome. If you're a buyer trying to get into that market, then that's a problem. What's not always understood is most buyers are sellers first. So the reality is when we had that kind of rapid appreciation, individual families on the one hand had an awesome opportunity, their values are going up dramatically, but how were they going to replace that property once they sold it, right? So it was not just a black and white issue of they're going up too fast, too far, let's slow it down. There's a lot that has to be done there. And it's not precise, right? When they decided to increase rates to slow down the rate of appreciation, there was a lot of people worried you're going to crash the market. Don't play such a heavy hand. Stop raising interest rates. To date, I know that in the fourth quarter, by the fourth quarter of last year, they had slowed appreciation into that 2 to 4% range for the last few months of 2022. So I think they're feeling very good about themselves. They're like, we're not crashing the market, we're not losing value dramatically, and we're on a sustainable path. That's important to understand when we talk about what's going to happen next, because whether you're a buyer or seller, while it's important to understand what has happened, what you really want to know is what's going to happen next. If you're in the market to buy, our price is going to go up or down? It's an incredibly important question for you as a consumer. Likewise, if you're a seller, is my value going to go up or down? Am I going to lose the gains that I've hard earned over the last 5, 10, however long you've owned that asset? And so when we are working in the markets, talking to buyers and sellers every day, these are the questions we get asked every single time, right? The realtors on our team in the audience, they're not in their heads, right? Like, yeah, everyone wants to know what's going to happen next. It's probably the most difficult question for a realtor to answer. And I'm crazy enough to try to answer it for you. So this is where we start. This is what you're going to be reading, what you're going to be hearing at a very high level for the rest of this year. What's going to happen with rates? What's going to happen with affordability? What's going to happen to supply and demand? If you're starting on this journey to think about buying or selling, the more aligned you are with what's going on, and then either working with someone like us or through your own research and study, try to interpret what's going to happen next so you can make these really important decisions. So that's not going to work tonight, so we'll just do it the old-fashioned way and scroll. So the next thing I want to share is, again, depending on your point of view, exciting chart or a scary chart. And it's simply showing US home prices seasonally adjusted over a long period. Here, we're talking pre-1992 through the end of last year. So what you see clearly here is, obviously, you have long sustained periods of price appreciation nationwide. In between those periods, you have in early 1990, 91, loss in valuation, right? Most of us live here in Silicon Valley. Even if we weren't in the market to buy or sell houses, we remember that, the dot-com bust, right? We, more than anyone in the nation, remember that recessionary period and that point where we were losing value in our homes here in Silicon Valley. It affected our most important industry and naturally affected housing and prices here. Then we had that massive run-up from 1992 all the way through 2006, early 2007, right? And then it crashed. And then for those of us that lived through it or worked through it, 07, 08, it was bad news every single day. You didn't want to turn on the market quickly. You didn't want to watch the news because it was just bad, 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 and then worse. But we made it through one way or the other. We made it through, and in terms of valuation of our properties, again, this is when we experienced that 25 to 40% drop in valuation, right? But from 2012 on, we've had nothing but appreciation. If you bought at the worst part of the market in 07, 08, and you held it till today, you regained and doubled your investment, right? That's important. That 07, 08 period was the worst period for house prices for the last 50 plus years. And the aftermath of that worst price recession ever has seen the fastest appreciation in valuations that this area has ever seen, right? So for me, again, someone who lived and worked in that time period, at the moment, it felt like, why would anyone ever buy a house? Like a terrible experience, right? But the reality is, if you had a long enough view and you understood the fundamentals of our local markets, and you weren't buying and selling year over year over year, it was an incredible opportunity. And a lot of people made hundreds of thousands of dollars by making the decision, I'm going to buy real estate in 09, in 10, and 11. And the reality is, even if you bought in 2017 or 18, you've made quite a bit of money in that period of time. Now, if you're looking at the chart, you should be looking at one thing, right? Like, okay, that's awesome. 91, 08, 2012, and in 2022, look at those red lines, right? So again, we don't hide from the headlines and the numbers and the facts, but we always want to pause it again and say, we're not buying and selling houses like we would a stock, right? The Case-Shiller index is designed to mirror like a 500 index. And so we can see the performance of real estate over time. But the fact of the matter remains, we don't trade housing like we trade stocks. There's no day trader in housing. There's no I buy it today, hold it for 30 days and sell it in the general market. When a consumer buys a house in California, on average, they stay there for 10 years. They stay in that property for 10 years. That's the average. And that average is growing, by the way. It used to be 7 years, even about 5 or 6 years ago. So the consumer in California is buying property and staying in it longer and longer and longer, right? So again, if you see these red lines down there, right, you have to understand that. Buy at the right pricing, at the right time, right location, things like that, but have that longer outlook, right? And we'll touch more on that in a second. Any questions so far? Right, we're just warming up. We're just setting this up for you. Further in the article, they talk about this. In 2023, Goldman Sachs expects double-digit home price declines in major markets like Austin, San Francisco, San Diego, Phoenix, and Denver, and Seattle. Like, when do you get into the good stuff, Robert? We want to hear good news, right? I'll get to it. And in fact, this is setting up the good news, right? But again, I've got to be honest and share with you what is out there in the market, what you are hearing, you're reading, what you're watching in the news. And Goldman Sachs is an incredibly reputable organization, right? Full disclosure, we are affiliated. They're an investor in our team. And so I love what they have to say. I don't hide from it, but let's really explain it, right? So let's start with this. If it says San Francisco, the San Jose market is probably 1 or 2 points worse than San Francisco, right? Just so understanding. So if they're showing a 13.7% drop expectation in San Francisco, it'll probably be 14 or 15 in San Jose, right? If you're in Sunnyvale, there's slight differences, but we're talking 1 or 2 points difference, just as a frame of reference. But what I like to point out, let's look at Austin market, right? If you've been paying attention at all to high-tech news, real estate news, things like that, Austin is a darling, right? Everything's about Austin. Everyone's moving there, everyone's buying there. The barbecue's great. The last part is definitely true, right? But I want to show you something to really understand our local markets, what you're going to have to decide when you're thinking of buying or selling here. Yes, read the headlines. Yes, understand these numbers are not wrong, right? Goldman Sachs is not in the business of misleading clients, right? So let's really deconstruct it and really understand what that means for us. So think about that. What they're saying is from the peak, that was around June of last year, to current, these areas have lost that much valuation. So what does that mean? Does that mean that you own a home, you lost 10%? No, it means they measure on median prices. So there's a couple of things there. Anytime markets take a pause or a decline, the first houses to come off the market are the higher priced homes. They don't have to sell, generally speaking. So if they're expecting anything but a gain on the sale of the property, they just won't put it on the market. What does that do to median prices? Even without the sale actually taking place, you measure what's the value of the properties on the market. If you've taken out the top 5, 10% valuation in any market, the median price will immediately drop. Now, it's not misleading. That is a great indicator of what prices will do going forward, right? But understand that the first few months of any correction, the median price will drop immediately because the higher price homes come off the market. What then is going to result in actual price gains or drops is how do the buyers transact with the listings that are still on the market, all right? Again, I'll go a little deeper into how that looks and how that sounds in our local markets. But again, for context, Goldman Sachs and many other entities expecting prices to revert, especially in these premier markets. So are we different? This is a list of a lot of the major areas in our country, and I want to point a couple out. The first thing, though, let's start with this. Here's a press release from the California Association of Realtors. They write, interest rate reprieve bolsters December home sales. Existing single-family home sales totaled 240,000 in December on a seasonally adjusted annualized rate, up 1.1% from November, but down 44.1% from December 2021. That's really important context, right? What you will see and hear in the news, sales are down. by a lot. I don't care what you're selling. If sales are down 44%, that's not good news, right? You can't sugarcoat that, but let's really explain what's happening. If the sales are down 44, that's the headline. That's what you're going to start with whenever you're starting your search or thinking about buying or selling. But then just below it, look at this. Statewide in December, the average price, the statewide median, only dropped 2.8%. Now, those two things don't feel like they match up one-to-one, do they? Sales are down 44%. Well, the market must be in decline. Prices are crashing, or real estate's on sale, depending on if you're a buyer or seller, right? Which is your perspective. But then when we really look at, for those properties that stayed on the market and received offers, went into contract and closed year over year, they declined 2.8%, right? Now, whether you're a homeowner or a buyer, which is the most important number? You don't transact on a median price. You transact when a buyer and seller agree on a price, right? Is it important to understand the context of median prices? Are they up? Are they down? Absolutely it is. But when it comes down to actually making a decision, I want to sell my house. You'd like to buy it? Okay, I would like this price. You're only offering this. Let's go back and forth. We finally agree on a number. He doesn't offer me the median price. He offered me what he thinks it's worth to him. I counter with I think it's worth to me. Either we reach an agreement or we don't. If we reach an agreement overall in the state, 2.8% decline year over year. Mind you, after 2 years, we saw anywhere from 30 to 40% gains, right? So did the seller sell at the absolute top? No, that was in June of last year. But did they get an incredible gain on their property over the time period that they owned it? 100%, right? And that's the power of time in ownership in Silicon Valley. Even if you buy at the lowest point, at the worst spot, if you're holding for a period of time, your gain will be more than offset any potential dips at any point that you own it, right? Here's the opportunity. If there is a 2.8 average drop, well, it stands to reason some properties sold more and some sold less. So can you identify the opportunities in areas where that average dip you can take advantage of as a buyer? As a seller, how do you avoid that? How do you avoid your property falling into even a slight decline in year-over-year prices? It's an average. That means some homes are selling for more than they did last year. Some are selling for less. Whether you're the buyer or the seller, understanding how to identify, how to negotiate, and how to transact in that matter can be the difference between tens, if not hundreds of thousands of dollars, certainly over time, right? And so this is the level of analysis that we dig into, so that when you have questions as a buyer or seller, it's not like, well, this one's pretty and that one's nice and that's a great neighborhood. That's a given. We know that's what the consumer wants. And the reality is almost any realtor can help you with that. But once you identify the one you really like, now we get into, what about the value? Can you help me save or make money? Well, that's only possible when you understand the nuances of our market, what's actually going on in the financial markets, and what is the appetite of the seller and buyer to reach negotiated prices on the actual sale of their house, right? Here's something else really interesting. When you're looking at these macro numbers, Austin, Phoenix, San Francisco, down, down, down. Look, remember we talked about the Fed getting supply and demand back into a balance? How do you balance this? Austin, located in Travis County in Texas, Austin has a population of about 1 million people. Travis County, where it sits, has 1.3 million people. In December of last year, they sold 2,435 houses in Austin. 2435. That was a 30% drop from the year before. Again, massive losses year over year in sales. What about us? Well, we here in San Jose sit in Santa Clara County, 1.9 million people. very similar in population, right? We sold 663, right? Let that marinate for a second. When we're talking about, let's get supply and demand back into balance, right? We can only sell what we have out there. So we sold 663 properties because we barely had 700 for sale. There was 3 or 4 times that number available in a city like Austin, right? Same populations. Not to mention, we're surrounded by massive cities from San Francisco, Marin, all the way down through Monterey and East Bay on the side. In Travis County, it's Austin and then little tiny rural areas all around it. Not to say one is better or it's just different. So when we're thinking about, when you read or you hear these stories that could sound apocalyptic in some senses, it's okay to start there. We start there too, because we need to know what you're hearing, what you're seeing, how you're feeling. But then our job becomes, you're not buying in Travis County. Unless you are, we can help you with that too. But you're buying here or you're selling here. And even in an area as big as Santa Clara County, right? Are you in the West Valley? Are you in East Valley? Are you in South County? Where are you located? What area is your house located? Or what areas would you like to buy in? Because the story I'm showing of an Austin versus San Jose, Santa Clara County, when we just focus our lens here in this county, then we can again, well, are you over here? Are you in the West Side? What area are you looking at? They're all very different. It's okay if you start with these big numbers and they sound scary or whatever, but when you engage with someone like us that really digs into what's really going on and they can explain it to you, that makes a massive difference. How does that make a difference? Again, let's start with that big picture. Here we see home price appreciation by Metro, and at the very top is the bottom 5. Change in valuation from the peak. And you can see San Jose at the top or at the bottom, depending on how you look at it. And we see from the peak a 15.5% drop in valuation. Not good news, right? But that's from a 201% gain since 2012, right? Why is that 2012 number so important? Remember I said something earlier about how long do people stay in their home on average in California? It's 10 years. So it wasn't a random number that they picked to show from 2012 to 2022. That's the average length of stay. So when you purchase in Silicon Valley in 2012, right, you only months removed from a catastrophic drop in valuations. Who in the right mind was buying then? Well, actually very smart people or lucky, right? That 10-year average, 200% gain. And now if you're selling today, when you could have sold in June of last year, that's where they say there's that loss. Is it a real loss? Right? It's a coulda, woulda, shoulda, right? Perhaps. But the reality is you're up 180, 190, 170, even 150, right? So when, especially as a buyer in these markets, in these times, if you're in a position where you have to buy for some family need, work need or something, don't be distressed about the current market. We will help you understand and navigate the current market and still try to get you value today. But you should have, in my opinion, a longer term look. If you come to me today and say, I would like to buy a house, immediately I know on average, you will be there for 10 more years. And whatever price you pay today, it'll go up in value in that time. Now, we do have clients that say, I'm an investor. I'd like to buy a house today, do some remodeling, fix it, and sell it in 3 months and make some money. Now I'm not so bullish, right? Now I'm like, well, I'm kind of nervous about that, right? If this was 12 months ago, I'd say, let's do it. Let's buy 3. But now I owe you that duty of the numbers I look at, the trends I look at, and in giving you advice, like, look, you got to have a lot of buffer built in if you're on that 3 month, 6 month cycle. The reality is those buyers are not prevalent today. They know this, so they're not out there flipping homes. right? The buyer that's out there is a have to buy. Who are they dealing with? They're dealing with sellers that have to sell. And so that's why I would keep saying, the time you're in, your current wants and needs, with a maximize current situation, but always look at the long term. That's how you're going to be able to transact positively right now in this market, right? So these numbers don't scare me because the majority of clients we work with do have that longer time, right? We started with a headline that said, we're in the second biggest price decline since in the post-World War II era. That article, I'm going to show it again, was written January 25th. Sorry, December 25th, around that. Now, 30 days later, another very reputable source, Redfin, has a new headline. The housing market has started to recover. In 30 days? Is that possible? 100%. And we'll explain why. That's probably the most important thing right now, is how fast our markets move. Most realtors, and frankly, most clients, are conditioned to think the home buying process is a long, drawn out process. Historically, it has been 3 to 6 to 9 months. Properties lasted 3 to 6 to 9 months on the market. When we look at normal real estate data, we frame it in quarter or year over year, month over month. When we move in days, what does that matter? I'm going to show you. For one thing, you can have these kind of headlines 30 days apart. They're both correct. So in this, you can see it's very clear, at least in my mind, and I'll try to explain it. We left a market of sub 4%, sub 3% in some cases, interest rates. The Fed again said, that's causing massive appreciation, unsustainable appreciation. We don't like that. We're going to do something about it. They cannot stop people from selling their houses. They can't affect the supply part of the equation that much, but they can affect the demand equation. How do they affect the demand part of the equation? You make it more expensive to buy a house. How do you make it more expensive? Well, you're going to borrow money from us, aren't you? Yes. We're going to charge you double what we charge everyone else just 3 months ago. Interest rates are going to go from 3% to 7%. So if your monthly mortgage payment at 3% was $4,500, $5,200 a month, with our prices and our valley, that's not uncommon. Double that. Now you're at 8, 9, 10,000. You sure you want to buy that house? Well, it's not surprising what happened, right? You can see the decline in interest rates from in May, April, that time period, all the way to 7, and then mortgage applications. Right on cue. As we kept raising the interest rate, fewer and fewer people thought, I think I'll buy a house, right? You can measure that as a forward-looking number by who applies for the mortgage. When someone applies for a mortgage, you can see that 2 to 3 months later, they're in the market making offers and writing, right? So mortgage applications, an incredibly strong indicator of future market activity. We track that, and we'll explain how we track that and how we make that make sense for you and help you make really important decisions, right? So again, it's not rocket science. You make it more expensive, fewer people want to buy it. If fewer people want to buy it, then that has a lowering effect on prices. It's quite simple, right? But it's important to understand that's not just backward looking. You can use these same principles to see what's going to happen next. Again, always that question, what's going to happen next, Robert? So we are at around 6.1, 6.2% interest rates. Expectations are we should stay in that 6.1, 6.6 range throughout 2023. So we don't expect it to drop below 5 or below 6, I should say. We don't expect it to come back up to 7. Now, that's not just me guessing. Consistently over the last 18 months, the Fed has warned us on what they're going to do, and they've delivered as promised. When they said, we're going to raise, they raise. When they say, we're going to raise it again, they raise it again. When they say, we're going to raise it 3 more times, they raise it 3 more times. So at least in this cycle, just listen to what the Fed says. And what they're saying is we want to keep it in that below 7, but above 6. That's the range. If we don't have massive moves up or down, the current environment should sustain throughout this year, right? That's very important to understand. What we have seen since rates have settled around that 6%, buyers have jumped back into the market. Here's that what I was pointing out, 30 days, completely different headlines. If you're a buyer or a seller in the market, 30 days doesn't seem that much. But if you started your search or listed your property before December 28th, 30 days later, you're still in the market, the house is still for sale, time has changed completely. Completely, right? That matters. That could be the difference in 1 or 2 or 3 or 5% of your purchase or your sale. That is a lot of money in our markets, right? So if you're getting information today and using that to make buying or selling decisions over the next 60, 90, 120 days, how many times can this headline change? How much higher can it go or how much worse can it get? We do weekly analysis because that's how fast our markets move. The speed of our market is not measured in years, it's not measured in quarters, it's not measured in months, it's measured in weeks. From 2000, I would say 17 through early 22, it was measured in days, 9 or 10 days to completely sell out properties, right? You cannot make really truly informed decisions if you're on a 30, 60, 90, 120 day cycle on the information you're receiving to make decisions. So we offer weekly. I'll explain a little bit more about how that works in a second. So lending is always the key to what's going to happen next in real estate, right? If you've been in Silicon Valley for any time, you heard cash is king. And the way I do math, 75 to 80% of properties are purchased with financing, 25 or less is cash. 75 is bigger than 25. Financing is key. When we look at what's going on with finance properties, it gives us a better reading of what's going to happen next with prices. And I'll explain that in a second. What we hope to have you understand is, again, what are the headlines that you'll hear? You're going to hear purchase applications are down 39% year over year. That is bad. There's no other way to color that, right? If you're in the business or looking for lending and the availability is down 39% year over year, that's horrendous, unless you compare it to the 45% that was down just weeks before. So down 45, down 47% year over year, that was October, November. Since around mid-November, that number has been improving. So is it bad? Yes. Is it getting better? Yes. In the short term look at what we see in buying and selling properties, that short term, 3-week, 4-week, 5-week, 6-week cycle plays more part in what it's been doing for the last quarter. If you don't believe that, I'm going to show you the numbers in a second. But this is what we're setting at. Are buyers coming back to the market? Yes. At the record levels of 21 and 22, early 22? No. But at solid, sustainable numbers historically? Absolutely. And that's what we use to drive our analysis. This you see here going back to early 90s from the Mortgage Brokers Association Purchase Application Index, what I was referring to earlier. Look where we are right now over the last couple of months. We are the worst we've been in new purchase applications since around 2014, 2015, right? Now, in the midst of the crash of 08, 09, we had more people applying for mortgages to buy houses when it was crashing. When it wasn't conjecture, we could see it falling. We could see prices falling. And at that time period, more people were applying for a mortgage than they are right now. So how can I be positive about real estate knowing that number? Well, important distinction. When you know it's falling, you can price in your decisions, right? In the middle of its fall, it's down 10, it's down 20, it's down 30, it's down 40, where we ended up. A buyer's like, well, I know how you invest. You buy low, you sell high. In 08, 09, in 2010, it was 20% higher just a few months ago. I should buy now. So see, even the middle of a fall, a dramatic fall, historic fall, the mentality of many buyers was, it's on sale, I'm going to buy. Right now, we don't know. When we don't know, we don't make choices, right? So we're still in the middle of like, are these prices sustainable? What's up with these interest rates? What's going to happen next? So whenever we're in a period like that, we don't know for a fact, will it go up, will it go down? You're less likely to make the option to buy any product, any service. So for me, this is incredibly helpful. If we can help you understand what's going to happen next, then we move you into the camp of like, I've got a solid idea what's going to happen. Far more likely to make a reasoned decision to buy or sell, right? As professionals, here's my challenge. If I met you 2 years, 3 years ago, like, what's going on in the market? It's going to go up. We all know it's going to go up. We see it going up. There was always a small percentage like, it'll crash, it'll crash. That person is always there. They're right every 10 or 12 years, right? But the majority was like, it's just going up. Not too much involved in conjecture or analysis. It's just going to go up. And the question was, how much higher, right? Just like in 08, 09, 10, we knew it's going to go down. You know the direction, you can make reasoned decisions. Right now, we don't know, at least not as clearly as we did in those time periods. My position is we actually do, right? That's my challenge. Let's look at the demand curve here. This is Santa Clara County single family residences, right? Let's hone in what's going on right now. So I'm going to show you a number. It's very wonkish. I apologize ahead of time, right? Got to be a real numbers nerd like me. But try to explain it. We know the climate over the fourth quarter of last year wasn't good. Not a lot of sales. Prices were high. Interest rates were high. A lot of talk about recession coming. 2023 is going to be a bad year. Layoffs for the first time in a long time. In our tech industry, we're untouchable, right? Suddenly we're not. So all of that kind of angst and that kind of like, we don't know what's going to happen, is something we didn't feel in this market for a long, long time. And suddenly it's here front and center. And what happened? Look, in our real estate markets, we see the declines. We see from around May of 22 last year, when the interest rates really started to rise, this line here, which is pended properties, this means I was qualified, I saw a house, I liked it, I made an offer, we're in contract to buy it. You can see the decline, steady over time, right? Here's the thing, fourth quarter was bad. And you see that because when you look at the solds, comparing the first 25 days of December to the first 25 days of January, 43% decline month over month in houses sold in Santa Clara County. Again, that's a real number. That is bad in any market, 43% fewer sales. A couple things, it always falls from December to January, not at this level, but part of that's tempered. It's supposed to fall from December to January, right? Here's a number I saw that was like eye-popping. Those closed in those months pended in October and November. The ones that are going to close in January went pending in December. And look at that. It only fell by 20%. Right? So this is what I mean by it's wonkish, right? It's still down 20%, Robert. Yes, but the rate of decline has lessened. That tells me buyers are back in the market. Not 21 levels, not 2020 levels, but a healthy, sustainable 2023 level. That rebalancing that the Fed talked about in September of last year, this is it in action. This is the manipulation of the interest rates to get us back in line with supply and demand. Again, if you're a buyer or seller, that's really important. That's going to have more effect on what's the value next week, next month, than what we were experiencing in September or June of last year. And again, you can see here from Redfin, pending sales. 3 record years before, if we're comparing to those 3 record years, yeah, we started the first 3 weeks of January much lower, or lower, I should say. But look, we're already starting to see the natural trend. So we will not see the demand that we saw in 2020, 2021, or 2022, highly inflationary periods. we will see increase. Now, not a lot of people are saying that. So it takes a lot for me to stand up here and say, whatever you're reading out there, let's look at the facts on the ground in our area, in our location. Look at the trends from past years. It will look and act the same. We will not have the rapid 10% increase in the first quarter this year, but we'll likely have 1 or 2 or 3%. Right? And if you're in the market and you're reading that high level news, you're going to go write offers that won't win. And that means you're going to have to write a second or third offer at 1 or 1.5 or 2% higher than you could make right now. If you're a seller, you got to know, don't read the headlines. Price it correctly, put it on the market effectively, and get the number you deserve, not what the headline is saying you should get. That makes sense? So the numbers keep building up this way. I'm going to get to this part here. So we should by now be conditioned to this reduced inventory levels that we've been experiencing for years, over year over year, 18 to 19 to 20, 21, 22. Now we see an increase, slight increase. Is it enough to reverse the inflationary trends that we've seen over the last half decade to a decade? I think not. If it was much steeper, if we were doubling or tripling inventory, I'd be more worried. But we're not. It's actually still a very low number. So the demand side, after a correction in the third to start of fourth quarter last year, has recovered and is growing. The demand is growing. On the supply side, it has grown, but not by a lot. We still have a very low inventory environment. So those two things together point to pressure on prices up. We have seen that over time. When we had 3,000 or 4,000 or 5,000 homes in the market in this area, prices declined, right? Since that time period, since around 2011-12, sustained, maintain low inventory environments. Again, the population that we have in this market just don't jive with how many properties do we have available for sale. Millions of people, hundreds of houses. And that won't change for the next 5 years, 10 years. You might get blips up and down, but over time, we're not going to add 2,000 homes to the market. We'll probably never see that again. And we continue to import and create buyers that can afford these houses. We don't expect to double again or 200% increase for the next 10 years, but sustainable, reasonable 10, 15, 20% over multiple years. That's a great investment in any class of asset. And so again, if you're buying, yes, there's pressure on you for the price and things like that, but it remains a long-term great investment. If you're a seller, have reasonable expectations, understand the gains you've already made, and capture as many as you can by understanding the local market that we're working in. So this is the last part, the speed of the market. Very new concept really in real estate. I've been doing this for 20 years, and this is quite new. Again, usually we measure real estate in big periods, years, quarters, months. But what you can see here is, bottom line, big picture, when you see in any given market that the month's supply of homes for sale is below 2 or 1 month, the pressure on prices is pretty significant in that 2 to 4% range. Now, we were seeing again 10, 15, 18% year over year because we weren't being measured in months of supply. We were being measured in days, 7, 8, 9 days. It's not even on this chart, really. We will see and continue to see, and that's why we look at things weekly by market, sub-market year. We start looking at how many homes are for sale. What supply of homes do we have? Is it below 2 months? Is it below 1 month? If that supply is that low, then we look at future demand. How many people are applying for mortgages? It's rising. When we look at those factors, we know, again, when buyer and seller get face to face, they must reach an agreement for there to be a closed sale. Everything else is just theory. Everything else is just conjecture. I will sell it for this number. Do you agree? If you don't, can we negotiate? Finally, we got a number. That's the market we're in. And when you're a buyer or a seller, That's the understanding you have to have. And I don't see anything happening to increase this month's supply in the near future, or even next year or the year after. Let's skip to what's going on in our local markets. The other thing we do in our team that is very unique, I know it's unique because I've been doing this for 10 years and we're still the only ones that do it. We look at trends. One of the best ways to see what's going to happen next, answer that question on the mind of every buyer and seller is, well, what happened the last time? What were the conditions, right? Every Monday morning, I wake up and I measure and I document sales, pending, active, single family and condos in all the major areas in Santa Clara County. And I start with what's the whole county doing? So we look at, I know, and you probably do as a buyer seller, know what happened in 2020. You know what happened in 21. You know what happened in 22. Prices went through the roof. Why? Because demand supply equations were so out of balance. We start in January 2020, only 413 homes for sale. That's nothing in our demographic. We started 21, only 542. We started 2022 with 278, the lowest number ever for a January start. We doubled it this January. Well, that's the supply. What about the demand? 2020, higher demand, higher number of pendings than active. 2021, higher than active. 2022, way higher than active. 2023, much lower. Right? Now, this is still, this 570 to 313 ratio is still strong enough to maintain and even grow our prices. Right? For prices to decline, either this number will have to grow dramatically or this number will have to drop, and they have to happen at the same time. So we measure that. We look at past years where we had stagnant growth but avoided price drops. The last one like that was 2019. Where did we start 2019? Look at the relationship between active and pending and what it grew to by the end of the year, right? So it's not a crystal ball, but it's about as close as you can get. We look at all these factors. What are the future demand ratios that we look at? What's the supply look at? What happened the last time we had these conditions? And while rates are higher and prices are higher, we watch every single week. How did it move? Are the ratios still in line? Are we haven't seen pressure on prices up or down? That's for the county. Then we look at individual areas. Let's skip this part right here. And we go straight to, this is what I was talking about. I measure every single MLS area in Santa Clara County. So if you're a buyer or seller in West Valley, in Milpitas, closer to South County or East San Jose area, we look at what are the conditions. If you're thinking of buying, where are you thinking of buying? What is happening to inventory? You can see across the board, inventory is higher. Some cases, triple digits higher than it was at the same time last year. That alone is not enough to tell you what's going to happen to prices, right? We were at historically low. Remember I showed you that number? We started with 278, lowest number ever. So even we're 100% higher in some areas than we were last year at the same time, that's still a third or fourth lowest number ever, right? So that's very important. Does it matter that we're 40% fewer or 100% higher? Yes, in relation to what? To record years. Historically, we're very competitive and alignment with what we're usually expecting over the last decade. When we look at pendings, we see the same thing. Down 24, down 44. This is also incredibly important. Remember I told you, mortgage applications are a leading indicator of what will happen in the next 2 or 3 months. So when we see late January, for example, Sunnyvale, sales are down, pending are down 51%. Well, in early October, when people were first getting pre-approval mortgages, we were down 49, 48%. That's not a very distinct difference. Those numbers that dropped to 48 at the start of the process are now generating numbers that are 51% down when they're actually transacting. So is it a big number year over year? Yes, but is it in alignment where the market was and now that is growing? That's what you have to think about, right? Because if prices were doing one thing in June of last year, what really matters is what's it doing today. When we go out and see a house that you like, we have to analyze what has it been doing the last 7 days, last 10 days, last 15 days. That'll have a greater effect on what is the price, what is the competition like, how aggressive can we be, or maybe an opportunity to get a deal. But that's the analysis we have to make. And I'll finish with this. I use this delta number. What is the difference? Inventory rising in this case, pendings falling. So when you see an 83% delta, for example, in Sunnyvale, that means you just take what's the number of inventory rising and the drop. And I made this up. I want to read, can we see how that's affecting prices real time? The number is not made up. That is an 83% gap, for example, in Sunnyvale, number of homes for sale, number of offers being written. Well, watch this. You meet with one of us and you say, I'm thinking of buying or selling in Sunnyvale. We'll show you something like this. And we take that forward-looking number. How many people are applying for mortgages and writing offers? And you see in this red line that is measuring Sunnyvale absorption rate. And absorption rate simply measures, no matter how many homes are on the market, how fast are buyers taking them off the market. Anything above 30% is considered a seller's market. 30%. What have we seen in Sunnyvale? Triple digits. So when you're seeing something that's in the 400% absorption rate, that means within the first 4 or 5 days of that month, everything was gone. Speed of the market. When you were in the market to buy in Sunnyvale, October 21, you had to move fast. There was 20 other people lined up to see it on a weekend. There was 5 other people writing on that same house. But what happened to the prices? These are the price wars you read about. And when we could see that absorption rate, because it was a leading indicator, 2 or 3 months later, they closed, we had recorded prices. So when you see absorption rates shoot up, you can see in the later months, the list to sales price ratio shoot up. Conversely, when we saw the absorption rate finally begin to fall, lagging list to sales price ratio began to fall, right? So like if you had met with us, let's say in February 22, you want to buy in Sunnyvale, we tell you prices are still shooting up dramatically, but they're going to start softening. How do we know? Because we'd show you this. And now if you were like, but I need one today, Robert, say, okay, we're gonna have to go in, we're gonna have to go 10, 15% over asking price, and you're gonna win it. But you're gonna have to pay for it. Because we can read the market. If you're like, well, I know I'm not that much of a hurry. Can you wait 4 or 5 months? Yeah. Okay, we can probably go into a softer market in 4 or 5 months based on these numbers, right? And then ultimately we saw, this is what I was describing earlier. Fourth quarter, we started to see the rebalancing. Sellers that were holding out for higher prices realized I'm not going to get it. And if I have to sell it, I have to negotiate. Buyers have a little bit more power. I still have the upper hand, but I can't demand or expect 10, 15% over asking price. And by fourth quarter, you can see they were getting 95%. Now, you see this here from November, December, absorption rate shot up. Again, buyers realized it's not on sale, or at least not to the extent I thought. I still want it. I have to negotiate a winning number. And that's what you see. So when we were talking to buyers and sellers in November, December, we said prices are going to go up in January and February. Why can we be so confident of that? Because these numbers track over time. I can go back 5 years, I can go back 10 years, you can see it. So bottom line, if you're in the market to buy or sell, you're going to hear all the national news. You're going to hear a lot of pessimistic views. You're going to hear a lot of year over year bad numbers. They're not wrong, but what's the context? If it's a bad year over year number compared to what? To a record year, right? If you see Steph Curry go out and score 30 points a game, that's awesome, but that's not our normal, that's expected, that's his average. if you ever get lucky enough to go watch and score 50, I got to do that once against the Clippers. It was amazing, by the way. 50 doesn't happen every night. So when he scored 50 points against the Clippers and I tuned in the next game and he scored 35, like, well, man, that's a 25% drop game over game. This guy's washed up. No, he wasn't, right? He still hit his average. It was still a great night. It just wasn't a record night. And that's what you can't fall into the trap of in real estate right now. The headlines are true. I'm not trying to denigrate the Goldman Sachs, the Redfins. They are true. Sales are down 30, 40, 50% year over year. Mortgage applications are down 39, but it's improving. And the speed of our market is still very, very fast. And the speed of that market is in fact what allows us to do this kind of interpretation, this kind of real time. This is what's going to happen next. I don't have to figure out what's going to happen in 5 or 6 months. We can have a good idea, but if you come to me, you come to one of my agents, we're like, we're looking to buy in the next 30 to 60 days. That's our wheelhouse. If you're like, I got a longer outlook, then why don't we do another 30 days of data to see if we can figure out what will happen in 30 or 40, 50 days. And then I'll leave you with this. All these numbers are averages. So when you're looking at homes are at this average price, they're selling around 95, 96% of asking price. That's an average. The nicest homes, the ready turnkey homes are still selling over asking price in the first week or 10 days. If that's what you're looking for, you have to be ready to compete at that level. If you're like, I don't want to pay that premium, I'd rather price in a potential 3 or 4 or 5% correction over the next 6 to 9 months, well then maybe get that 7 out of 10 house. That'll price in any correction that might happen. But you can get that 8, 9, 10% below. Be very clear. I'm not telling you can get the nicest one for 8 to 10 below, right? Don't quote me like that. When we identify what is your want, what is your need, we look at this data and we try to give you the advice necessary to win at your pace, at your level, and gain as much or save as much or win as much as possibly can in this market. All right. So that's my hour, 1 minute over. I was really trying to be on time. If you have any questions, I'm happy to stay. If you online want to write out any questions, I'm happy to answer them. But even better, reach out to one of us and we'll give you a one-on-one 30-minute consultation, looking at where you're looking at, where you're thinking of buying, where you're thinking of selling, and we'll distill this information even further down to what are you looking for. All right. Thank you, everybody. Have a good night.